What's happening, everybody? Before we dive into this week's video, which I'm really excited to share with you regarding out-of-state investing, I roped in one of the best Phoenix multifamily brokers. I also want to share with you an off-market opportunity in core South Bay. It's located in Lawndale. 8 units, all 2-story XXL townhomes. The average square feet per unit is over 1,350 square feet, double the average size of normal units. Totally renovated, totally turnkey, buffed out, with great rental rates in place. So I'm going to share some information on that as well. If there's interest, please let me know, and maybe we can get a deal done. Thank you.
My goal is to meet and help as many apartment owners as possible by sharing real-time information gathered by my transactional volume, outreach to owners, and data. All right, so today is May 27th, 2020. We're still right in the middle of the COVID-19 pandemic. I have on the left-hand screen Paul Bay, good buddy of mine, Marcus and Millichat Phoenix office, one of the top producers in that office. And the reason I brought him on today is because he is driving up the market in Phoenix. He's a multifamily broker and he knows his stuff. And so I'm excited to have a conversation, casual conversation with you about what you're seeing out there, and kind of what to expect investing in Phoenix. So Paul, why don't you take a few minutes just to introduce yourself, the team you're on, and sort of what you guys do.
Yeah, thanks, John. I appreciate you, bringing me in for this. So yeah, part of the David Gebbing team, Cliff David, Steve Gebbing, and I've actually been brought in to cover, small to mid-size apartment properties out here, but we really cover the gamut of, multifamily in Phoenix. Partners are doing institutional Class A properties, but we do see a lot of properties and a lot of data points on, just transactions. Last year we did just over 1.6 billion in transactions. So really getting big. Yeah. And myself last year, 29 transactions. So this year hoping, we'll see if I can eclipse that, but we're definitely on pace to at least get close to that number again. So
let me interrupt you real quick. So the other guys in your team handle the institutional deals and you're focused on the private clients. Can you explain what that is, what that means?
Yeah. So, let's put a dividing line somewhere in the ballpark of, 20 million, where you start to see, institutional, more public funding assets that where, private equity would be more of a typical investor, maybe someone who's exchanging out of California, for instance, or a private investor who owns several assets themselves, or a small group of investors or syndication group, publicly traded companies, real estate investment trusts, those types of organizations would be institutional Class A type groups. And yeah, again, usually 20 million plus would be the type of investment that they're looking for. So we're able to take the research and the level of presentation for those types of assets, and also kind of share that with these small to mid-sized deals as well.
So you're working on properties from $1 million to $20 million price tags?
Yeah, a million to about 15. I mean, right now the average deal size about 45 units. About 5 million. Okay. I have a 10 unit on the market. I have a 92 unit that's about 15 million.
Sure. So we obviously here in California, we work with syndication groups, funds, but also a lot of my business and the clients that I help are private, you call them mom and pop owners, right? And so I'm sure you still are dealing with a lot of mom and pop sellers and buyers out there as well, right?
Oh yeah. No, that's probably a bulk of the business. And
from $1 to, let's say, $3.5–4 million properties.
Yeah, we do have a lot of them. And, again, obviously, maybe one of the benefits of looking at Phoenix, one of the first ones that jumps off in my head is the basis, even though we have seen a lot of appreciation, the bases, relatively speaking, are still lower. So you're going to see for that $3.5 million deal, you know, a jump in the number of units you have. So maybe you trade out of LA from a 4 or an 8 unit into a, you know, 12, 14 unit, 16 unit.
Sure. So I guess that goes into the next thing I want to ask you, like, why Phoenix? You know, we're in California. It's the best weather in the country. Real estate values have always appreciated the highest. Granted, there's some crazy stuff going on, but why Phoenix out of all the other places to invest in multifamily?
Well, I mean, I'm a little bit of a little bit biased. I moved here from California myself, so I clearly like the neighborhood. But I think, you know, the first one off the top of my head is the proximity, ease of getting to the investment. It's a 45-minute Southwest flight from Burbank or John Wayne. I mean, it's really accessible for most California investors. Secondly, there are some key, I guess, investor-friendly differences in the Phoenix MSA. Like, for instance, you know, you don't have to have full-time property management regardless of the size of the property. So let's say it's a 20, 40, 60 unit. You know, some might choose, once you get to that 60 unit property, to put a full-time resident manager on site, but you're not required to do so. That's one, you know, a scale opportunity. Secondly, and one that a lot of people find refreshing, is the property tax setup. So we have regulations in place where property taxes can't increase more than 5%, or the appraised value can't increase more than 5% annually. It's not reassessed on sale. So, you know, if your property taxes were, let's say, $450 per unit per year last year, and that's fairly common, that is kind of a bit of an average. You know, they're not going to increase from that more than 5%. Doesn't matter if it was fully renovated just recently, or if the value's gone from, you know, over time has increased dramatically. That's huge. So even if you improve the units and raise the rents 100% on a cap rate basis, from an appraisal standpoint, it's probably way more than 5%, but they're only raising the property taxes by 5% a year. Correct. So you can leave your tax attorney alone. Yeah, it's pretty cut and dry out in Phoenix. That's interesting. I've obviously done some deals out there, and I remember the guy that was touring the unit said that like to handle an eviction out in Phoenix is a lot more simple and a lot quicker and cheaper to do than it is here in California. I mean, for us, it's like 60 days minimum. They might put up a fight. It's going to cost you a bunch of dough. I think that's another benefit of investing in Phoenix as well, right? Oh, absolutely. No, very landlord friendly. I mean, you know, yes, I have heard a lot of positive stories about sellers being able to go through it. I mean, obviously, if there's a bad apple, really, there aren't too many restrictions in place that would prevent you from being able to, within, let's call it a 30-day period maximum, rectifying the situation. Another one that I think is relevant, and I guess more of a bird's eye, you know, Phoenix historically was more monocultural economically. There's more, you know, certain business or economy that was more tied with the real estate industry, you know, and banking. However, the super sectors, if you will, of economics, which are, you know, including business services, healthcare, educational, manufacturing, tech, those types of high-skilled jobs, we've seen a huge growth in the number of those throughout the valley. So I guess the strength of our economy has improved to a level where things like the current dynamic that we've been dealing with, you know, will not have as perceived of an impact as they have in cycles past in Phoenix. Yeah, I mean, you hear, like, you remember back in 07 and like maybe even 89, whatever, like the first markets just to totally tank were Phoenix and Las Vegas. And now it seems like
there's so much more insulation, and it's because, I mean, I was out in university in Arizona, and I just saw a bunch of big name companies moving out there because it's cheap to do business, it's business friendly, it's right next to California. You're still like quasi West Coast, you know, and so it all kind of makes sense. Do you have figures on how the economy is doing, or like do your buyers and clients tell you why they're so excited to put their money in Phoenix?
Well, I mean, I think, you know, again, consistently, like for instance, last quarter, you know, this is more of a market average. Some pockets like Mesa and North Central Phoenix are even higher, but we're, you know, historically seeing rental growth about a 10% year over year. It's most kind of where we've been stabilizing the last year, and that's, I mean, that's pretty big. You could make a dumb investment decision and feel like a hero in about a year, just because, you know, the rental growth has been outpacing, you know, really the rental growth has been outpacing where we've been projecting in our underwriting. We're being more conservative, but just the fact that we're having a continuous flow of people into Phoenix, about 100,000, give it like 100,000 per year, something like that, net migration, not enough new boxes to fill them. I mean, you know, that's just driving the rental demand up consistently.
It's insane. So, well, it's like, just to put in perspective, it's 5x inflation rate, annual average inflation rate of the rental growth out there. And it's 2x, more than 2x, the average rental growth here in Southern California. And
we're still on average a $1,200, just below a $1,200 rental market, which is
still affordable. It's still affordable,
yeah.
Much more affordable than California.
So yeah, and there are pockets which are hitting above. You know, again, this is why it depends on, you know, what is the right location. You know, I think there are more growth locations where right on the fringe that are, you know, still far below other areas like Scottsdale, Arcadia, Biltmore that, you know, have started to hit a higher rent threshold, but just generally speaking, more affordable. Yeah.
There's for sure more juice. I think there's more juice like across the country too. There's a lot to be excited about in multifamily, but you know, the adage that, like, you know, you bought an apartment building 40 years ago and you filled out the grant deed on the hood of a guy's car, the seller, and he said, only invest an hour and a half away from your house where you live, right? And so that's like what all the investors have thought for all this time. And now with Marcus and Mills Chap's technology and being able to like talk to a top broker in another metro, you start to see that there's tons of metros and submarkets aside from Los Angeles that have outperformed LA. For instance, Phoenix is one of them. It's outperformed Los Angeles, I don't know, maybe the last 4 or 5 years. You probably know better than I do. And it's due to rental growth and due to demand. And then you have, you know, markets like in Florida, like Orlando's a top market, Dallas. And so it's definitely eye-opening. And for you to say a 10% on average rental growth in Phoenix is insane to me. Like you could be shooting darts blind and, like you said, and still come out a winner.
Yeah, and truth be told, we don't, you know, again, in the current environment, I would not, we're not underwriting 10%. We weren't before, but I think just the fact that we have that continued migration, you know, will make it so that there's definitely some sustainability, if not growth, during this interesting time we're in, in the Phoenix market.
That's good. You guys are being a little more conservative now, which is good. You know, coming from a broker, people say the broker pro formas are out of whack, but you're playing it safe here. So we've kind of touched on it, but let's just go real quick. What's driving the valuations up aside from the rental growth in Phoenix?
Yeah, I mean, again, it is the rental growth. Obviously, constrained supply. You know, our inventory has been relatively low, so that plus, you know, the rental upside, more attention being put onto Phoenix has brought some considerable interest in the market, led to cap rate compression. I mean, we've, you know, that's one of the benefits we're seeing right now in the market. We, you know, there's still consistent activity, but 4 months ago, it would have been a real, you know, for a core asset value add, let's say, there would have been a significant commotion around it. Whereas now, like, for instance, say you're exchanging out of a property in California, there's interest all over the place, but I think you have more opportunity to maybe, to get in on a deal that has less commotion. And with an internal referral, we always take those very seriously. So
let me ask you, 10 properties trade between $1 to $5 million. There's 10 buildings that sold in 60 days, let's say. Out of those 10 buildings, how many of those buyers were out of state, not Phoenix residents buying those deals, apartments? 60% are out of state investors. So to me, that's amazing. It shows there's a huge demand. This has been going on forever, but I've just seen it more so in the last, 3-4 years here. But you have 60% of the buyers out of state. That's got to drive the pricing up too, right? Because more of the out of state guys or out of some market, like investors, they have a more of a futuristic perspective on value. And the historical guys who have been there forever, they're like a little bit more pessimistic. Never pay that price because I paid $100,000 for a 20 unit building, right?
Yep.
So that's because there's so much interest in Phoenix and it's a promising, story. It's starting to drive the pricing up as well.
Yeah.
One more thing too. So look, interest rates are interest rates, and you can get right now we're historically low. Cash on cash return is huge. It's not only cap rates that investors should be chasing, but it's like, what's the return on my money I'm going to get? And if you're buying, the average cap rates in like Southern California, South Bay, LA County, it's like a 4.5 cap. And you and I and our clients, we share the same rates. We're like 3 3/4. So if you can go out into Phoenix and buy a deal from Paul Bay at a 5 cap going in with upside, and you're still getting the same interest rate you're getting here, you're going to make so much better of a return out there. And there is an appreciation, there's more of an appreciation potential out there versus buying it here, making way less cash on cash return. And you'll probably make money, but it's proven that Phoenix has outperformed LA the last few years. So that's something you got to take into consideration too. It drives me nuts. It's like how, I can make compelling reasons for buying a deal out here if there's a significant value add, but the deals I'm helping my clients sell, we're selling them at really great prices. And if you can take that money and reinvest it in a hotter market, get a better return, it's something that more people should consider, in my opinion. Let me ask you, talk to us about a few submarkets. I know there's a bunch, and we probably want to just keep this short, but what are some of the hottest submarkets now? And what are some of the hottest submarkets you think long-term, a few years from now, like if you were to buy something today? And
sure. Yeah, I would say, I guess the hottest now would be, most of them are centering in around the core of Central Phoenix, but you have Arcadia, Biltmore, which is where our office is. I liken it to a Century City, if you will, for the Southern California investor. Biltmore is a Century City, that caliber of a location. There's not a lot of inventory, and not a lot of units, period, especially in the smaller C-class apartment space. But huge economic drivers. Same in Arcadia, which is the neighboring community between Biltmore and Scottsdale. So all three of those are probably the hottest, A core locations. And then just to the west of Biltmore is Uptown, Midtown. So pretty much all Central Phoenix and Scottsdale is where I would cluster in the hot zone for smaller multifamily. I would also then for the future outlook, I would point to areas that are on the fringe of, so there's the 19th Avenue corridor, Christown, which is more on the fringe of that Uptown, Midtown market. So just right outside of that core to the west, and then Mesa, which was recorded to have the highest rent growth in the country last year. It's still not all the way improved as you're seeing in some of those other cores of the market, but it's right outside of your alma mater. the Tempe, Arizona State University country, which is the largest public university in the country. So, something's got to give as Tempe continues to, and I don't know if you've been out there recently, John, but things have changed dramatically. So that impact has been moving more and more into Mesa, being that it's just to the east. So
I saw firsthand Tempe blow up. So when I was a freshman at ASU, Arizona State, which is in Tempe, there was potential and it was a great little college town. But I swear, man, by senior year, there was the whole Lake Town or
the Tempe Town Lake. Have you
development?
Have you? Yeah. I don't remember. It is, well, if you come out, you'll have to see. You'll be shocked to see how it's changed in just the last year. It's insane.
Totally. And I remember starting to look at real estate values, and they just went up so much. And then I got a couple of deals sent to me 2 years ago by someone and I was just totally shocked. And it seems like that's just going to pour out into locations like Mesa, and so that's pretty interesting. What are vacancy rates like? I guess just taking the average of all the submarkets. What's the vacancy rate out there?
So, it's we underwrite 5%, but it's lower than that. I think on average you're in the mid 3%.
So that's comparable to, that's how we underwrite. We've been underwriting the last few years at 3%. Granted, it's been less. Now I'm starting to underwrite at 5-6%. I still think it's maybe it's conservative, but I would have thought that Phoenix would have had an 8% vacancy rate, but it's crazy.
Yep.
So these are some of the things that I just feel like not enough people here in California understand. We touched on this, and this is huge. I think you have to look at this with every investment, but the affordability for tenants. You said the average rent's $1,200. What is it costing to buy a house in a decent location? What would the mortgage be, the average mortgage?
Yeah, I mean, there's definitely that barrier. In, say, that Biltmore neighborhood where you're going to see on a 2-bedroom unit, let's call it $1,350. I know that's a little higher than the average, but it's an A location. But at a home in the comparable pocket where you see that $1,400 rent is upwards of $500,000-$600,000. Right. So we're going to see
people are still opting to rent.
Yep.
Yeah.
Absolutely.
And it also seems like because the rents, we already chatted about this, but it's if they're $1,200 on average, $1,350, the salaries out there, I mean, the white collar workers still making entry $45,000, $50,000, $60,000, right? And so here they're making the same amount, but their average rent's $1,550, $1,650.
The quality of life out here, again, that's not as textbook of a reason why Phoenix, but for me, that's one of the main drivers why I moved out here. I would say that's something that even with the appreciation we've had, we've been able to sustain, relatively speaking.
Totally. And you think about the Biltmore location, I mean, the Marcus and Millichaps, CBREs, that's just commercial real estate, but you have these big companies, people making well over $100,000 a year, and they're only paying $1,350 for a unit, right? So the thing is you pay 30% of your income to housing. So, I mean, there's tons of upside, tons of juice left in some of the submarkets, right?
Absolutely. Yeah.
What are some of the biggest management issues in Phoenix? Maybe due to the weather or just the way buildings were built back in the 60s? What's going on there?
Well, I guess the one thing that pops in my head, what's a benefit in that you don't have to have full-time management at any size, also is a bit of a challenge, managing from afar. If you're paying for part-time management, you have to really understand that, the eyes on the property, there's not going to be a consistent 100% oversight on what's going on the asset. And I think sometimes folks who are used to having their hands on the property or seeing it, driving by it daily, weekly, there's an adjustment there. So reality is with third-party management, even though we have, great companies to refer that we, feel confident won't put egg back on our face, there is going to be an expectation change there that you're paying a lower cost for it. So, it's not like full-time management. So I think it's just an expectation shift that some people go through.
So what's the best way then, if you are California, you live in California, you sold an apartment building here, you want to get into an apartment out in Phoenix, like how are the people successfully managing their deals? Let's just say a 12 unit, because that's probably.
Yeah. I would say, maybe from that eyes and ears perspective, you have someone on site who, is trustworthy, that can, really keep an eye on things, but then, giving them a slight concession in their rent. And then working with one of these small to mid-sized management companies that also, the two that I would refer, have GCs built in. So if you're looking at even trying to do a value add from afar, you can, they can do a interior renovation program on behalf of the owners and, lease that up. So really have the two working, maybe having your own boots on the ground, getting on that Southwest flight once in a while, but then, working with one of the trusted groups that are competitive from a cost structure, but do the best they can, and they actually have a footprint in the rooftop of the property. So, you're getting the economies of a 100-unit building just because they have presence in that neighborhood across several owners.
So yeah, I mean, I think this is the biggest objection, or the biggest fear for the owners that I've talked to that seem like they're just ready to get out of California. They're totally committed, but they're, management, real estate is a management intensive asset. And so it seems like, yeah, you have to find a good property management company that you trust. Obviously we come to you or other people for referrals, and that's what I've done in the past. And it seems like because Phoenix is, 45-minute or 50-minute flight away, if you're going to make an extra $30,000, $40,000 in cash flow a year, and the flight costs you $150 on Southwest, and you do it once a quarter, it's like $600 a year in airfare. You expense the trip, you take your family or your wife out, you stay at one of the nice resorts, and you're still making a better return on your money, and as well as all the other benefits of Phoenix. But I think it really comes down to management, and I think I know a couple great management companies out there. I'm sure we probably know some of the same ones, and it seems like they're doing a good job for some of the other California owners out there. So another kind of, I guess, objection or thing I've heard is, like, we all know how quickly multifamily sells here in California, right? The average days on market is pre-COVID was 45 days. Then you're vetting buyers, finding sincere guys, ready to close, and we'll get the whole thing wrapped up in 3 months. And I think people are scared to get into out-of-state deals because they don't want to get stuck in something, and then maybe a few years down the line, something personal happens, they have to liquidate, or it's a bad market, it takes years to sell. So I guess, how long does it take to sell an apartment building in Phoenix, pre-COVID and now?
Well, I mean, I guess now is a moving target. I mean, as I think I've talked with you about, we do, even in today's market, we have, I have an asset that we're bringing out later this week that already has 4 offers on it. And, I mean, if, depending on the seller's demeanor and timing, that could move to best and final buyer selection within less than 30 days. So it's dependent on the asset, obviously, but I would definitely not be concerned about the ability to sell multifamily in Phoenix.
So what's the average days on markets for your team's listings?
For the team, I think it's less than 30. I think
less than 30 days. It's been really hot, hasn't it?
Yeah.
So, are we missing anything here that you think the California owners and investors that I talk to and reach out to? Is there anything that you want to tell them, or think we should tell them?
I think we're really hitting a lot of the high notes. I would just encourage folks, you know, especially in the current environment. You know, I mean, about coming up on my 1-year anniversary, myself and my wife thought of, you know, let's go travel for our anniversary. I thought, well, really, there's no place that's a better place to be right now than in Phoenix. So I'd encourage people to, you know, if they're considering selling a property or just, you know, working, you know, looking at a new market, to come out, see the market, and, you know, we'd be happy to help provide guidance when you're in town looking at opportunities.
Absolutely. I've always felt very comfortable referring clients to you. And for those who are watching this, if you are wanting to go out to Phoenix, Paul is more than happy to show you around, show you a few deals, show you the hot spots, some of the economic drivers in the area, and get you comfortable. In addition, if there's ever an interest in doing an exchange, you know, I pride myself on really knowing the market, maybe even better than my competition. And so I can't say that the same thing for being out there. And so I would, you know, it's in your best interest for me to partner with Paul, and we certainly would do that for you to make sure we found the best upleg asset out in Phoenix. So it's kind of a little duo representation for all of you. And, you know, there's really no one better to take advice from in Phoenix than Paul.
And I think just one last thing on that. I mean, reality is because there is, you know, a lot of activity or interest in Phoenix in the good deals specifically. Anytime someone like John rings us up and gives some, you know, color, little background on an owner, it significantly increases probabilities and helps overcome any hurdles that would be associated with someone's, you know, not having the ownership history in town. You know, we really, again, see it take those referral or those internal dialogues and handoffs very seriously.
Absolutely. You've done that in the past. I totally appreciate it. It's been a great time picking your brain on Phoenix. I will include Paul's contact information in the description. And if you guys, like I said, ever want to get out there and talk to Paul, he's more than happy to do so. Thank you, man.
Thanks, man.
Appreciate it.